Good afternoon. I welcome you all to this very important VCM. And the topic for today is the exposure draft issued by the Valuation Standard Board of ICAI on Valuation Standard 304. And this is on valuation of assets in the extractive industries. Well, the industry itself is very important core to any economy, and as the term extractive would mean that we are extracting raw materials, be it from the surface of the earth or the aqua. And typical examples would exemplify in nature of the fossil, non-fossil fuels, natural resources in the nature of commodities basket, like the coal, graphite, and all of these are very important because unlike India, many of the economies are one commodity based, like on titanium or what we call the oil sector or the gas sector. Now the sector itself has very peculiar features. One is the resources are non-replenishable, and more than the natural resource itself, possibly till the time it is within the confines of the earth or the water, possibly it doesn't have any commercial value. But it is the process of extraction, which is the upstream, midstream, and downstream production, which makes it marketable. And the entire thing involving whether it is the gas sector or the oil sector or the minerals, whether drilling, pumping, or mining. So all that is making it marketable. Now, if we look at the peculiarity, number one, the resources are unevenly distributed. The process is highly capital intensive, longer lead time and extraction cycles. But look at the entire perspective from the angle of their role in the economic development. If we talk of India, possibly in the drive to have more manufacturing capabilities, more buoyant production cycles, we cannot but highlight the use of these natural resources. So the entire value creation aspect in the form of whether it is the conventional resources of what we call gas or minerals, or the unconventional resources, and given the thrust in terms of the sector itself and making it marketable. Now, what is important is in terms of the policy parlance in India, we have looked into more and more FDI into the sector. Along with this, now we have a related concept of the sustainable developmental goals. And if we look at the 2030 agenda and some of the specific SDGs like 6 and 7 on clean water and sanitation and affordable clean energy. And if we talk of indirect SDGs, namely 12, 13, 14, dealing with responsible consumption, climate action, life below and above the earth. So I think the tone of extractive industry, its interface with the environmental laws, namely the conception of CBDR, common goal, but differentiated responsibilities. So I think a very complex sector, and the Valuation Standards Board, in its drive to build the capacity of the members and guide the stakeholders in general, has come out with this very important exposure draft. And this VCM is to get insights not only from the experts. So we have a distinguished panel today, the chairman Anil Bhandari, C. Anil Bhandari, CMP Vijay Kumar, the vice chairman, the three experts who are the members of the institute, as also the registered valuers, CA TV Bala Subramanian, CA Parag Kulkarni, and CA Rashmi Shah. So with this, I would request the chairman of the Valuation Standard Board to share his perspective and drive today's VCM.
Well, very good afternoon first to all our members. And I believe, I think we have more than 1,000 members who have logged on to this VCM. So that shows the interest within the community to understand valuations around extractive industries. Typically, you can't speak much after, you can't add too much of context after Rakeshji has already added his bit. And I think he always tries and puts it up very, very brilliantly. So I think thank you, Rakeshji, for having set the context right for our members to understand complexity as well as sustainability. I think both of them become very important. I'm not sure if sustainability is a part of our valuation standard within the extractive industries anywhere, Parag, but maybe a food for thought is that, can we bring in some sustainable questions within the valuation? So anyway, that is, I think, for a matter of academic discussion, but thank you once again. And thank you, of course, to my vice chairman, who's been actively part of all the discussions that we have done so far on Sundays. I have kind of, always brought him out of his Sunday holidays. Doesn't get too many anyways. And has been always very interesting. So the one thing that I learned throughout the year, valuation, of course, is a very complex but a very interesting topic. And more we discuss, I think the better it gets and our understanding gets better and better. And I was in call with Parag today morning about LIBOR and our guidance note on that. So I think that was fairly complex as well. I didn't know the head or tail of that, but I think, again, a very interesting area to be discussed. So in the same light, thank you so much, Parag, for being part of this VCM here today. Thank you, Rashmiji, for being a part of this VCM and, of course, contributing to this entire journey of the extractive standards right from the beginning. And I believe that, a fantastic effort has been made. And TV, thank you so much once again. I do understand that you have a throat infection and you may want to be silent. And I was joking, MPV, with TV that the less you talk about valuation, the better actually it gets for valuation, right? So TV suggested that you might try to speak less and maybe add his 2 bits. But just for everybody's benefit, if TV happens to be quiet, it is not because he doesn't have a view. It is just because that he may have a sore throat. Yeah. And of course, Sarika for holding all of this together. Needless to say too much around what has already been spoken about. I believe it's a very important, extractive industries are very important. They're at the core of any country. They're at the core of the success of any country. And valuing the asset becomes very important in our journey of valuing the organization if they were having extractive industries as a part of their investment. And I think one would need to understand more about the industry here than about the concepts of valuation. And I think it is a perfect place for all of us to debate the exposure draft. So not wasting too much of our time here, I would like to give it back to maybe MP Vijay Kumar, if he would like to add any comments in terms of, set the context of whatever you think, MPV. But thank you once again for all the members to have joined. And I'm sure this is going to be a very interesting discussion. More questions that you raise is likely to be very, very interesting for us to make sure that the standards are appropriate and they have become very useful to all our members. So I think to MPV.
Thanks, Anil, for leading the board exceptionally well during the year. It was a pleasure working with you. And thanks to both you and Rakesh for having set the context. Given the fact that we have 3 subject matter experts who will lead the discussion, I'm actually very, selfish, greedy, that the 1,000+ participants who are here should actually give us feedback or inputs to make the standard a much better standard. I'll just leave some opening thoughts. One, as all the members are aware, the ICAI Valuation Standards have been drafted grounds up by the Institute. And these standards which have been drafted through a very robust process. And I'm pleased to share, and I'm sure all of you will also acknowledge this, that over the period, not just in India, I've come across professionals from across the world who have been in awe of these standards, the way the standards have been drafted with such clarity, lucid language, and structured so very appropriately. Having set such a high benchmark, and I've had the opportunity of discussing with the Ministry of Corporate Affairs last week, and I was very pleasantly what I shouldn't use the word surprise, but at least it was very nice feeling to hear from the ministry that they were extremely happy with ICAI's efforts on the drafting of the valuation standards, which currently are being followed by ICAI RVO members and the ICAI members for other valuations. Having set such high benchmark, we have now attempted drafting a valuation standard on a specialized industry. For those who have been in the profession for quite some long, you will be aware that globally attempt has been made for drafting standard on this a couple of times, and it has not fructified. In fact, even as a guidance note, it hasn't really fructified. And at the institute, we have now made this very big effort of drafting a highly industry-specific standard. Standards generally are principle-based, and if you look at our other standards, all of them are principles relating to class of assets or the valuation process, outcome and all. So when it comes to a very highly specific asset class like this, where there are multiple dependencies as well, and the industries are also quite unique in terms of mining industry or extraction industry of oil versus coal versus iron ore. Each of them are quite different. They're quite different, come with their own set of complexities. There is also an interplay between tangibles and intangibles which are there. There are complexities associated with some requirements of financial reporting requirements as well, including impairment valuations, inventory valuations and all. It's just too complex to address this. But credit to the study group of the institute. They have put the best minds together to come out with this exposure draft. And I have been a very strong believer that standards get to become a standard only because of the robustness of the process which is followed, particularly the comments which we get on the exposure draft, the insights which you're able to gather from a wide variety of professionals with varying experiences, their contributions and inputs. At the institute, having been associated 6 years, I can share with you, while we may not share with you in the public domain how your comment has been deliberated, I want to give you the assurance, confidence, for whatever it is worth, that my experience of 6 years, every comment is read line by line, word by word, punctuation to punctuation, debated at the Valuation Standards Board or Accounting Standard Board or Auditation Standard Board or Ethical Standard Board before they actually become a standard. So your comments mean a lot to us. So sincere request, as the subject matter experts Parag, Rashmi and Balu take you through this, and they will also be happy to listen to your thoughts. Please feel free to share your thoughts today and probably during the exposure draft period also. Please give your 4 or 5 hours of time and please be very critical. It's our institute, it is our brand. The product is enjoying a very high brand now. And with this, we'd like to ensure the product branding goes up further, and it will happen only because of your critical comments. And as I said a little while ago, industry-specific standard globally has been attempted, but have not been successful. We are confident with your inputs, we should be able to make it successful. So with this appeal, I leave it to the safe hands of the panelists to interact with all of you and gather your inputs. Thanks, Anil, once again for having led the board so exceptionally well. And it's always been a pleasure to listen to Rakesh. And it's so difficult to speak after him. Next time, I'm going to lay a condition that I'm going to participate only if I'm speaking before him and not after him.
Absolutely. Well said there. Well said.
And thanks, Sarika, for, as always, so competently hosting the various activities of the board. Thank you.
So without wasting too much time now, Sarika, I think let's put this back to you, and maybe you might want to initiate this and let's start.
Yeah. I would now request Rashmi ma'am, without taking much of the time, to initiate with the presentation or share your thought on the subject, ma'am.
Yes, sure. Please allow me to share the screen. Good afternoon, dear participants and members. With great pleasure, I would like to present ICAI Valuation Standard 304 on valuation of assets in the extractive industries. This standard essentially prescribes guidelines which could be applicable to the valuation of companies operating in this particular industry. It also includes interests or rights held by entities involved in this particular sector or in natural resource properties, and which will essentially include, industries of mining and petroleum. But yes, it does not include activities which are focused on extraction of water from earth. So it will be essentially mining and petroleum, but not water. What this standard also does not cover is the downstream assets or assets which are involved in the distribution of products to retailers or fabricators. From the metal refineries or say mineral processing plants or petroleum refineries and natural gas processing plants. So as we all know that, there could be several purposes for which we can require, which we could be required to undertake valuation of mineral properties. And this is also considering the fact that the reported and intangible form of the said assets, it may not reflect the true value of the said assets. So some valuation purposes could include mergers and acquisitions, accounting and financial reporting, transaction purposes, bankruptcy or restructuring, impairment testing analysis, tax computations, initial public offerings, financing, acquisition of rights or grant of rights, litigations, etc. So this is why we need a standard in place today. Before setting the context or before actually moving on to how we can value companies operating in this sector, I thought it will be essential to take everyone through the key definitions. A reason being that this is fairly technical in nature. It could also require inputs from specialists and technical experts. So I'll just take everybody through the key definitions and key terms which could be used by the companies, and for the valuation also it will be essential. So yes, the standard provides us some key definitions which are essential to know and understand before undertaking the valuation of such assets. If I was to begin with the basics, I would like to mention that any deposits of extractive industries, it will mainly be found in faraway or remote locations, and it will predominantly or maybe even completely be found below the surface of the land and probably below the floor of the water bodies. So the first step to production will be in the form of extraction of such natural resources from the surface of the earth. And these natural resources would mainly be wasting or depleting in nature, like say gold, silver, diamond, gemstones, or they can be petroleum deposits, natural gas and their variants. Now, any company which is undertaking or is engaged in mining operations and extraction of resources is called as an extractive company. What is a mineral? A mineral will be a naturally occurring material, and by definitions, it does not include petroleum. A mineral reserve is an economically mineable part of a measured or an indicated resource, and this has to be substantiated by a feasibility study, which again has different levels of confidence. We also have reserves which can be divided into probable and proved mineral reserves depending on the level of confidence of extraction again. There are many studies which have to be conducted to substantiate the probable quantity and quality of the deposits that could be extracted. Most domestic and global, they do undertake various studies, and at various levels there are many assessments that take place, which will always show a higher level of confidence as the project supersedes one level to another. So the first part could be a scoping study or a preliminary economic assessment. So what is that? It's very technical in nature, and it indicates the potential viability of the mineral resources. It also mentions whether or not the project has any potential, to go to the next step of a pre-feasibility study analysis. Now, in a scoping study, a lot of what we say, generally available data and benchmarks are used. So a very high level of inputs and assumptions are used without getting into the details, like, what is the target to explore, or what are the historical estimates. And, these historical analysis, they will generally not form part. So yes, a scoping study is a very rough study, and it's at a very draft level, and maybe the first stage analysis of the overall project. A pre-feasibility study is then undertaken after the scoping study, and this gives us a range of options for the project. And generally, it also indicates the level of mineral resources which are determined. After scoping and pre-feasibility, we have something called as a feasibility analysis or a feasibility study, which is very comprehensive, and it is very realistic because it's backed by factors like, what are the environmental impacts, what is the government regulation impact, what are the operational nuances, engineering, economics to the whole project, legal issues, if any, which could concern the sector or the company. So these kind of factors are taken care of in a feasibility study analysis. And so the level of confidence which is there in a feasibility is much higher than maybe a scoping or a pre-feasibility study analysis. In a feasibility study, the level of confidence will always be stated. And yes, so like every asset has a useful life, there is also something called as a life of mine plan. That is essentially a design and a costing study of an existing mining operation, and it considers all factors like the geological factors, the marketing factors, environmental factors, the metallurgical factors, legal, government, social, engineering, all these factors, and they are also called as modifying factors. The term that is given to these factors which affect the overall mining process and the stages of the whole operation are called as modifying factors. Another important term which is essential to understand would be on the various categories of mineral resources and reserves. Now, there are technical experts, and they derive the geological evidence with the help of a lot of reliable and detailed exploration, testing, and sampling, so as to keep upgrading the project status from one point in time of observation to another. So we'll start with mineral resources first. So assume there is a large part of surface of the land that you see. Now within that you see a concentration or some occurrence of any mineral or some solid material, maybe on the Earth's crust or inside it, which you as a technical evaluator think that there is some grade or there is some quality that it poses, and there are some prospects for it to have economic value upon subsequent extraction. That gets termed as a mineral resource. Within mineral resource, we have three categories. So the first one is the inferred mineral resource, then it is indicated mineral resource, and then measured mineral resources. Inferred mineral resource means, it is that part of a mineral resource for which the quantity and grade or quality, they are estimated on the basis of very limited, evidence and sampling. So the geological evidence is very limited in as far as the inferred mineral resource is concerned. So there is geological evidence, but it is not sufficient to probably demonstrate any future continuity of grade or quality in this. So that will be an inferred mineral resource, and definitely because it is not based on sufficient evidence, it has a lower level of confidence than that we can apply to an indicated mineral resource or a measured mineral resource. So indicated mineral resource again is a part of mineral resources, but for which you have sufficient confidence with regard to the physical characteristics of the mineral, say with concerning the shape, the grade, the quantity, the quality, etc. And these characteristics you can apply the various modifying factors to for future mine planning and also for evaluating any economic viability of the deposit. The third and the most confident category is the measured mineral resource. And this means that a part of the mineral resource for which the physical characteristics and the quantity, they are estimated with above average confidence. So such that you can apply the modifying factors very, very conveniently. And this, of course, helps us in the completing your life of mine planning and also the final assessment of the economic viability of the deposit. Given this background, an indicated mineral resource will have a lower level of confidence as compared to a measured mineral resource, and at best it can be converted to a probable mineral reserve to the right, if you can see in the diagram. And a measured mineral resource, it can be converted to a proven mineral reserve or to a probable mineral reserve. So like resource is a much wider term, reserve is a subset of the resource, and mineral reserve is actually the exact economically mineable part of a measured and or an indicated mineral resource. Okay, so reserve will be a subset of the resource, and it's actually an already understood, or it's an already indicated economically mineable part of the overall resource that you have determined. So mineral reserves are defined by studies, which studies the pre-feasibility or a feasibility level study with sufficient confidence that yes, extraction is possible and it is also justified. So mineral reserves will always be backed up by a good amount of study and good amount of reporting in the pre-feasibility and feasibility study analysis. What is probable mineral reserve? Now, this is an economically mineable part of an indicated or a measured mineral resource. The confidence in the modifying factors which could be applied to a probable mineral reserve is lower than to a proven mineral resource, because proven mineral resource is, it's more economically mineable, and the degree of confidence that the evaluator gives is much higher, and that is why the name, proven, that it is much more adequately justified to be mineable or extractable in future. We need to highlight certain significant considerations, because as Sehgal Sahab said that, this industry is very technical. In fact, the key inclusions and exclusions also at times could be a little challenging. But yes, so it is understood that valuation for the mining and the petroleum sector could be more challenging as compared to other asset classes. And why? Because there is a lot of ambiguity over the quantities which could actually be available for the purpose of extraction as compared to what you have undertaken in your studies. Okay, so nobody can absolutely be sure as to what the exact quantity could be at the actual time of extraction. That is point one. Then there could be uncertainty in terms of pricing. So once the commodity is extracted after production, and at the time of actually marketing it and selling it, there could be a lot of uncertainty and deviations and variations in the prices. So that again is something which as a valuer you need to consider appropriately. Then there are various costs which are of course guided by the relevant accounting standards also. But yes, there are various costs for commissioning, for extraction, for production that you need to take care of. And this could again pose some challenge along with the recoveries because of the timelines. Like, it could go on for years, and you will realize that what you have extracted is by far totally something different than what you were actually forecasting. So the timelines in the overall process compared to the cost that you have incurred and vis-a-vis the actual production that has actually happened, they could be significantly different from each other. So yes, that's again one challenging part. There could be some economic and physical and contractual considerations which could restrict the life of the resources, because there are a lot of regulations and there could be legal hassles, there could be disputes between owners, so there could be ownership disputes. So yes, so overall the life of the asset could change or could be binding on certain aspects, or it could even be restricted to some extent because of physical, economic and other considerations. There are a lot of government regulations. There is taxation concerns also, along with the costs which are associated to finally restoring, rehabilitating or decommissioning the whole project. So that also needs to be assessed. So once everything is done, you are back to your asset retirement obligation and the whole procedure around it. And that is where the valuer and the technical specialist has to take care of those parts as well. While building a model or, while understanding or trying to consider a particular approach or method of valuation, there are certain considerations where we as valuers can, consider and take care of, because, as such, considering all the challenges that are there in some companies which are in this sector, and they have very, very specific attributes, it's important we understand these valuation considerations or aspects. So yes, for valuers, assets of extractive companies, it could be challenging, considering that these companies have very special and very niche attributes, and also considering that any kind of analysis for such assets, it may require technical and specific industry expertise as well. Now, the risk profile of the project, it keeps changing and it keeps evolving from one level to another. So say, for instance, from an exploration project, it will become a resource property, and this will further evolve to an undeveloped resource property, and this becomes a full-fledged producing mine. So there are various processes and there are various stages which the project will ultimately achieve while moving forward. Now, at the beginning of the project, the process is very speculative, because even the technical valuer could have a tough time really analyzing what the actual estimate of reserves and resources could be. But yes, as the project develops, the project becomes a combination of various assets. So not only the mineral reserves, but then there are also tangible assets like structures. Then there are plant and machineries which will be used for extraction and further production. So at that point in time, the procedure will be a sum of the parts valuation at that point in time. So at the beginning, it's very speculative, but as and when the project develops, it's a combination of the intangible and the tangible portion both. Now, the appropriateness of each valuation method, it will depend on the stage at which the extractive industry is, right? So there are 4 stages of the extraction industry. The first is the exploration, the resource properties, then development, and finally the production properties. Identification and classification of extent of the reserves or resources, the rate of production over the life of mine, the various capital and operating expenditures over the life of mine, some certainty or any ambiguity regarding the title, some other legal considerations, determination of expected future prices for minerals, petroleum, and then say availability of reliable and adequate data and information regarding comparable projects, the various stages like I've explained, of the regulatory approvals, and the stage in which the subject resource is at the time of the valuation, the ability to understand and forecast the risk towards progressing to the extraction stage. So the various sources of and availability of financing of various stages, availability of infrastructure and its financing. I think all of these need to be given a good thought and good assessment before we can proceed further in the valuation approach and methodology section. So generally, the appropriate valuation method is decided based on the development phase or exploration stage of the property. Mineral and petroleum properties will generally be classified like under categories like the exploration properties, the resource properties, development properties, and production properties. The categorization is based on the different stages of exploration and development, and also the different level of risks. Exploration properties, so what are they? They are basically mineral or petroleum property interest that is under active exploration for deposits or accumulation. But as of the valuation date, or as of that time, its economic viability is not demonstrated. Okay, but there's a lot of active exploration happening, but the economic viability is not substantiated or demonstrated. Resource properties, you will find some mineral or a petroleum resource, but again, it's not substantiated or backed up through a pre-feasibility study or a feasibility study to be economically beneficial or viable, or to be commercially proven that the project could be taken forward. So yes, there is some evidence, but it is not substantiated, it is not backed up. Development properties, they are established as economically viable through a feasibility study, but again, there is no production in such properties. And finally, we have production properties. They are properties under active ongoing production operations of mineral and petroleum products. And as a practice, any property with mineral reserves, they will be valued using the income approach, while any property without mineral reserves project could be valued using market or cost approach. Like we mentioned before, the various methods and the approaches for valuation of the extractive industry companies, they are in alignment and they are in sync with the valuation approaches and methodologies prescribed under ICAI Valuation Standard 103, which is on valuation approaches and methods. And essentially, all everything falls under the market approach, the income approach, and the cost approach. So generally, these three main valuation approaches, they will be adopted to measure value of extractive industry assets as well. So to sum up, while selecting and applying the valuation approach, the requirements of this standard have to be followed consistently in addition to the requirement as contained in ICAI Valuation Standard 103. The final value should be based on application of appropriate weightages, and where more than one method is being considered by you as a valuer. And I think as valuers, we also need to provide justification for applying a particular weightage to a particular method, along with stating reasons for using one or more methodologies, along with why we are using a particular method and what kind of weightage we are applying to each method. Now, like I mentioned before, considering the nature of the asset, we as valuers may need to place reliance on technical experts, on specialists who have estimated the quantitative information and also other technical information, which then forms basis of the valuation, in a very significant manner. That forms the basis of our overall cash flows or computation of multiples. So yes, we may have to rely on experts in this case. In such a scenario, we should specifically disclose in our report that we have placed reliance on technical experts, and along with details of the expert and the type of report that we have obtained from such an expert, and we have relied on that particular engagement. With this context and background, I would request Parag Kulkarni ji to take us through the various valuation approaches and methods for valuing exploration industry companies.
Thank you so much, Rashmi Madam, for setting the context. I'll also put on record heartfelt thanks to our Chairman Sir, Anil Sir, and Vice Chairman Sir, MPV Sir, for leading from the front and always being available, and with their audacious capacity to lead and contribute technically. So thanks to both of them, first of all, for allowing us to form this small group and work in tandem to create something for which we are open to hear from the members and from the industry. So please utilize the question segment to ask relevant questions, because it's still a white paper, not the issued standard. I also place on record thanks to Rashmi Madam again, for majorly contributing in bringing the structured format of this standard, and Valu Sir for critically evaluating it and helping us formulate the existing state of the structure that we have. And obviously Segal Sir and Sarika Madam are the people who do not let us go away. They always want us to be here and work. With that background, I would like to first speak on the life cycle in the mining in order to set the context, because I believe that if I directly jump inside the approaches like market, income, and cost, it simply becomes a numerical calculation without understanding the context. So to lay that context, I would imagine a life cycle of the mining into potentially 3 or 4 different cycles. First could be the research and exploration, which is nothing but the quest for resources which are suitable for intended economic use. Now, often methods such as geological surface mapping and sampling, or maybe geophysical measurements are carried out. Sometimes they also perform geochemical analysis, drilling, trenching, and sampling in this particular stage in order to pin out the potential deposits. So initially you can imagine, everyone is speaking, there is a possible resource, possible mine that is available. And like Rashmi Madam has explained through a particular diagram where we are moving from possible resource to probable reserve, and then from probable reserve after measurement to proven reserve. So in order to move from one set of resource to another set of reserve, basically a mining company needs to go through a life cycle where the first step was the search and the exploration. In the second step, we try to evaluate, and an evaluation is nothing but an understanding of the commercial viability of the mineral resource by assessing the technical attributes such as tonnages, grades, recovery, contaminants, adulterations, and maybe through various methods of extractions and metallurgical processes. That's where we try to analyze the commercial properties such as potential availability for the infrastructure or utility in transportation, or we also try to analyze the legal limitations for the exploration and also the potential market. Now, once these two stages are over, then we go into the third stage where Rashmi Madam has very well articulated that there could be something called as a development asset. So that's a development stage where we actually commission the facilities to extract, treat and transport the produce for commercial production with the help of excavations. Potentially will be used in construction of tunnels or roads, and maybe also we do that in removing the waste. So this is a third stage. After that, we go into the production where the extraction and processing that results in a marketable product for the commercial purposes. And the last stage you can imagine could be basically a stage where mining has been completed, but now because of the government regulation or maybe out of the moral responsibility, basically you rehabilitate the site for the restoration purposes. So with this context, now I'm able to imagine exactly what is happening inside the mining. Now, before I reach the approach, like if you read this white paper on a valuation standard, it basically makes reference to the existing valuation standards issued by ICAI. The first reference it makes to valuation standard number 102, from where we need to identify the valuation base and valuation premise. So there are basically three bases. If you read valuation standard 102, one is the fair value, second is the market participant specific value, and third is the liquidation value. So apparently we are assuming you are choosing the fair value as a valuation base. Now inside the same standard, you have to choose the valuation premise. If you read even para 31 of this white paper, which actually makes reference to a valuation base, and here the underlying assumption is that out of 5 different valuation bases, highest and base use, going concern, then as is where is basis, then on orderly liquidation basis and on post liquidation basis, we are assuming, if you refer to para 31 of this standard, this white paper, we are assuming that as a valuer, you need to assume the highest and base use of the mine. And now, after identifying the valuation base to be a fair value and valuation premise to be highest and base use, now is the right time to go into valuation standard 103, which basically speaks on the approaches and methodologies to adopt while valuing a mine. Now, if we have the existing standard valuation standard 103, do we need a separate standard and articulation around the market approach, income approach, and cost approach when we are doing a special standard for the assets in mining? Answer is yes. And I think you will realize it when we go through these approaches one by one. Answer is yes, because they are not as straightforward as they are or as they look when we are doing a valuation of any other typical manufacturing company or any other typical software company or any other typical trading company. Market approach, from the approach perspective, it remains the same. Basically, we use the multiple. Like we use the revenue multiple, we use the EBITDA multiple for typical valuations. Here also under the market approach, what we do is we use the multiple. And I have not yet gone inside the market approach. I'm just trying to give you the background. So don't feel as if, don't feel detached as if we are fundamentally changing the approach that we are using. The market approach that we have been using in other standards for valuing other kind of assets or instruments is the same thing that we do, but maybe we want to look at it from the niche perspective. That is, we want to customize it according to the needs of the industry. Under the income approach, again, the same thing that we do, that we work with the cash flows and the free cash flows for enterprise or free cash flows for the equity shareholder is the same thing that we try to discount by using the same methodology on the discount rate. But here, how we identify those cash flows is dependent upon the industry specific input, basically on the basis of the proven mine or the probable mine. And again, we need to build up a lot of scenarios. So no doubt I'm going to use Monte Carlo simulation lot many times when I'm doing valuation in such industries where the uncertainty needs to be embraced. And last but not the least, the cost approach again is the same cost approach where we have been referring to, let's say, the reproduction cost or replacement cost, but now we need to tweak in that cost approach so as to customize it to the industry. So having said that, I believe that now we are apparently ready to appreciate and now go into the valuation side. So the value of the asset is nothing but the function of surface and the subsurface of the geological information. And the sector generally has planned phase of extraction, and once the extraction is completed, there are no economically recoverable assets that can be considered for extraction at that point in time. However, for the petroleum industry, generally has more than one economical phase of extraction for crude oil. So exploration assets derive their value from the existence of economically viable deposits of minerals or petroleum in it. So the main source of value is what? It's nothing but the projected net earnings derived from these resources. And net earnings may vary from year to year depending on the type of asset or commodity extracted, or the pricing considerations that we have, or even on the basis of the cyclical nature of the commodity markets and production. But ultimately, assets pertaining to mineral and petroleum natural resources are valued primarily on the basis of presence of those deposits or those reserves. So we are asking questions on the basis of those four asset types that Rashmi Madam has explained you. There is a possibility of resource. By knowing more technical information, we are saying there is a probability of reserve. By knowing further information, now we conclude that there is a proven reserve. And then on the basis of this information, if you can imagine, even the uncertainty in the valuation, is moving downwards. The uncertainty, when we say that there is a possibility of resource, is very high. And that's where the standard deviation or sigma that we have in the valuation could be larger. And thereby the valuation could be less reliable. So the probability of success need to be bring in when we are working primarily with the possibility of resource. Rather, I would suggest, if I were you, I will not use the income approach for possibility of resource. Rather, I will potentially use only cost approach for a land that has been bought out by an industrialist and saying there's a possibility of resource. Only when I have additional technical information available, then possibly I can go on and say that, okay, fine, now there is a probability of reserve. And that's where I will build a lot of scenarios under the income approach. And then finally, for the proven reserves, I have the probability of success on a higher side. So that's again the background. There are three things which are important while we are looking at any real property, that is the ownership. First thing. Second is interest in such mineral and petroleum. So don't be under impression that just because you own the land, even you have the interest in such mineral and petroleum. It may not be. Okay. And third is, again, you may have the interest in minerals and petroleum, but you need a separate license to explore and extract those minerals and petroleum. So third important thing is right to explore and extract such minerals and petroleum. So valuer should consider, like I said, the highest and best use while you are evaluating these three basic things and then looking at that particular reserve. Now is the time, I think, where I actually jump in each of these approaches. Before we do, I'll repeat what Rashmi Madam had said. There are four types of properties. As a valuer, I will insist when you are creating the report or when you are attaching the value, I'll insist you attach a separate value to each of these four different assets. The first type of asset that she had said is the exploration properties. Second is the resource property. Third is the development property. And fourth is the production property, right? So each of these properties to be identified separately, and then accordingly, the value needs to be attached. Don't be under impression that all properties are development properties or production properties, and that's why the income approach is suitable for each of these properties. Like I said, if it's exploration property where the interest is under active exploration, okay. However, the economic viability has not been demonstrated, I will say that I'm not interested in using the income approach, because still, the economic viability is not fulfilled. So I may go ahead with maybe cost approach for doing the valuation of exploration properties. However, for the production properties, obviously I'll prefer to use the net income approach, or basically the income approach. So 103 talks about these three approaches. The market approach, let me just read out quickly the slide for you, uses the prices and other relevant information generated by market transaction involving identical comparable assets, liabilities or group of assets and liabilities, and is based on the principle of substitution of value. So you look at the transaction that has happened in the mining industry. For example, Aramco was listed on Saudi Arabia Stock Exchange a couple of years ago. So you go back, now you have the information available of the Aramco in Saudi Arabia's region context. So you have the revenue available, you have the margins available, you have the growth available. You try to compare it with the company under valuation who are having rights of mine, and then you compare. Obviously, you need to do some adjustment for the country risk. The country risk in India is lower than the country risk in Saudi because of the democracy in India vis-a-vis the autocracy in Saudi Arabia. Just a simple example. However, market approach doesn't end here in this standard. It goes on explaining typical multiples which are very convenient to this industry, and we will look at it subsequently in the next slide. Let me now read on the income approach. Now, income approach is the valuation approach that converts maintainable or future amounts to a single current amount, and then the fair value measurement is determined on the basis of value indicated by current market expectations about those future amounts, and is based on the principle of anticipation of value. Let me again draw example from the Aramco, because we already have the live example ready. Now, in case of Aramco, when they listed on the stock exchange, they agreed that they are ready to pay you minimum dividend for next 5 years. Now, one of the approach that we used is a dividend payback approach under the income approach. It's not always that you have to always do the estimation of free cash flow and then discount it. As an equity shareholder on a non-controlling basis, you can also use the dividend income which is guaranteed by the company if it is a listed, and if such kind of income is guaranteed from that resource, and then the valuation of company owning such land, owning such mine can be done without looking at the extraction, without looking at all these technical reports, provided that those reserves are proven. Okay. Obviously, the free cash flows can obviously be used, but then you need to deep inside the technical aspects, and those technical aspects are very well drafted in this valuation standard, and which we'll be looking at in the subsequent slides. Last but not the least, the cost approach. It is valuation approach that reflects the amount that would be required currently to replace the service capacity of an asset, often referred to as a current replacement cost, and is based on the principle of contribution to the value. Right? So you can apparently remember the market is a substitution of the value, income approach is an anticipation of the value, and cost approach is a contribution of the value. Now let's move on to the next slide. First, let's deal with the market approach. So like I said, it's the same approach that we have. We are using multiple, but now you can look at the multiple. It is not the common multiple that we use, as these companies are driven more by the assets. It is exactly opposite to the technology companies, which are driven more by the intangibles. Now these assets are driven more by the tangible assets. So using the price to net asset value as a comparable market approach could be relevant. For example, you look at those listed companies, you look at the market capitalization of these listed companies who are having exposure to the mining, and then these mining companies in their annual reports also disclose the asset value. So NPV of all mining assets minus net debt is basically the net asset value that you get, and then you identify the multiple. So market capitalization divided by the net asset value is the price to net asset value multiple of such comparable company can be identified. If you believe that certain adjustments are required because those companies are matured companies, those companies are having higher mining reserves, etc., then that particular multiple can be calibrated so that it suits to your company under valuation or your CGU under valuation for the impairment purpose. And then that multiple can be applied to the asset value that you have. So for example, if the market capitalization of a company is 100 and the net asset value is, let's say 300, let's say 50, then basically you have the market capitalization which is equivalent to 2 times of the net asset value. So if your company has the the net asset value of 10, then without any calibration and without any adjustment, the value of your company is basically 10 into 2. That is 10 into price to net asset value of the comparable company. And that's how you conclude the value to be 20. Similarly, you can look at these different multiples that are written here. Another is P to CF ratio, that is price per share to cash flow from operations per share. EV to resource ratio, which is basically the enterprise value to total weight in units of metal resources. And next is the total acquisition cost, which is basically the cost to acquire plus cost to build plus cost to operate to total weight in the units. So total weight in the units, you can either use the probable reserve or you can use the proven reserve. We typically use the both probable as well as proven reserve. If you are using probable reserves of your company, obviously in the denominator for last two multiples, you need the probable reserves, or rather the total weight of the probable reserves of the comparable company. If you are using the proven reserve of your company for evaluation, obviously you need the proven reserve of a comparable company. So this is basically sum and substance of the market approach. Now we can move on to the next approach in the next slide. In the income approach, the key steps to develop DCF model: first, to understand the life of mine for the resource. Second, analyzing the quantity of the resource to be produced every year for that particular time of period. Understanding of the commodity price to be considered for the forecast period of life of mine. So what we are dealing is basically the volume in the second, and in the third, price. So volume into price is basically your potential cash flow. So that's what the fourth point. The computation of total revenue is the volume that can be generated and the price at which it can be sold. The next step is estimation of operating cost, margins, and capital expenditures and other contingencies, the way we do for any other company. And then the computation of free cash flows and discount rate depending on the stage of production. Now, please understand that while we compute the discount rate and while we compute the free cash flows, for any typical other company, the complexity lies, let's say, in computation of beta or maybe some company specific risk addition through alpha. But specifically when we are dealing with the mining companies, here, as you can see in the bracket we have written, depending on the stage of production. So out of the 4 different properties that we discussed, you need to understand exactly where you lie. Are you the production property? That's the first thing. And inside the production property, exactly at what stage are you? The stage will represent different kinds of risk, and somewhere you need to capture that risk. I will suggest you to capture that particular risk of production in the cash flows instead of capturing in the discount rate, because discount rate adjustments are open to a lot of subjective defenses and subjective offenses, which means you can be questioned and then it becomes more of an arbitrary conclusion to say that this risk has been captured in the discount rate by increasing the discount rate by 2%. And a very subjective question that may come up is why 2%, why not 2.5%, or why not 1.5%? Having said that, that's why, I'll prefer to keep discount rate untouched to the extent possible. Only the identifiable risk that can be captured in the discount rate, I try to capture by using the beta. I tend to use less of alpha, and I try to capture all those risks through the cash flows. If I still believe that there's uncertainty around the estimations made, we will prefer to adopt a Monte Carlo model where we will run from 20,000 to 1 lakh scenarios in the income-based approach instead of just using a single approach. And that's where we try to sensitivize a lot of inputs that we use. So each input, maybe, through the triangular distribution, or let's say through, let's say, one of the distributions we will try to use under the Monte Carlo approach. And that's where we try to analyze the sensitivity of inputs and its impact on the valuation. And last but not the least, as I said, the calculation of the net present value. So still it's the same income approach. It has not changed fundamentally, but you need to look back. You need to go back and try to customize it to the extent possible for this particular industry. For a discount rate, again, you can use the CAPM method, or you can use the WAC, or sometimes the rate build-up method can also be used. So para 49 of this document actually gives you liberty to use either of these 3 models in developing the discount rate. Personally, I prefer the CAPM as it is a more robust model and it is less susceptible to technical queries. I believe that the rate build-up method can be used, but it becomes quite difficult for me to defend when I use the rate build-up method. So I personally don't use it, but presently para 49 allows you to use either of these 3 methods. Okay, So let's move on to the next slide now, the cost approach, the last approach. Like I said, it's again, it comes with the same thought process of the replacement or reproduction cost. But now instead of calling it as a replacement cost method, we are calling it as a depreciated replacement cost method, where the depreciated replacement cost is equal to reproduction or replacement cost minus physical depreciation plus functional obsolescence plus external obsolescence. Now, please understand that this particular guidance doesn't give you any commentary or additional guidance on how to calculate functional obsolescence or how to calculate external obsolescence. In the same way, we have the separate standard for intangible asset. Again, in that standard, there is no mathematical guidance given in calculating the functional obsolescence or external obsolescence, right? But then you need to use your valuation knowledge. You need to have the expert knowledge in logically applying the functional obsolescence and external obsolescence. The obvious reason this guidance is not explicitly mentioned in the standard is that standard should be a generic and it should give you the overall direction and it should not become a guidance note, right? So if you believe that the additional guidance is necessary, obviously that may become a part of the guidance note going forward, but we believe that that need not be a part of the valuation standard itself. Secondly, the cost approach can also be identified on the basis of multiple of exploration expenditure, which is basically nothing but the effective expenditure into PEM. And we can also analyze it by using the appraised value method, which is nothing but the combination of effective expenditure and warranted expenditure. Now, I understand that at this stage, you might be having questions about, these are all technical words. We are not able to understand exactly what has been mentioned. So, let me just quickly try to give you a view around multiple of exploration of expenditure method. Under this method, what we do is we first identify the prospective enhancement multiplier, that is PEM, okay, which is based on the valuer's assessment of the property of a property's potential use today. And then we apply it, okay, we apply it on the basis of the effective expenditure. So effective expenditure is nothing but expenditure that has already been carried till. Under the second appraised value method, there are again two types of expenditures. One is the relevant past expenditure, which is basically nomenclatured as effective expenditure. And second is the warranted expenditure, which is basically nothing but the warranted future cost, which comprise of a relevant exploration budget to test the identified potential and remaining potential effect. So this may look technically heavy, but there is no choice than to remain less technical in this valuation standard. With this, I believe the cost approach discussion is also over. And can we move on to the next slide? I think, yeah. So this is the last slide where we are going to discuss on the relationship between stages of development and valuation approaches for mineral assets. So under the valuation approach, like I said, the early stage exploration, advanced stage, development properties, production properties, then the dormant properties, or finally the defunct properties. So typically, where should we use the income approach? As you can see, only when there is an advanced stage of exploration or when the property is already in the development stage or a production stage, then primarily we use the income approach. Even for the dormant properties, only when you can basically resurrect the properties of the mine, then and if it is economically viable, then obviously you can use the income approach. Otherwise, if it is not economically feasible, you will not go and start digging, right? The drilling, even if you do that, it is not beneficial to you. So then the income approach doesn't make any sense. The market approach, however, on the other side, you can see can be widely used across the board, right? Except the development property, it is less widely used. However, it is widely used across all the stages. And cost approach obviously will be used in the initial stages of explorations. And when the property goes into the production phase, generally we will not prefer to use the cost approach. So typically, if I were the valuer, I will potentially use it in the early stage exploration or the advanced stage exploration. So with this, I think it's a time for us to take a pause and then open this forum for any thoughts by let's say Balu sir. I'll prefer Balu sir, Saigalkar, Sarika madam, if they want to make any technical contribution, they are most welcome. Up to you, sir.
Is there, would the seabed also form part of this deposits? Seabed deposits be considered? Example is thorium.
Yes. Because in the start of the standard, we did mention that anything under the ground, on the ground, or under the sea, water bodies and so not extraction of water, but if you are able to extract any deposits from seabeds, yes, that comes under the standard, under the purview of the standard.
Okay. Next is pricing of minerals are largely based on international prices. Could this be considered?
So in the income approach, when we are using an input, for example, you are selling extracted copper ore for the copper cobalt factory, then in estimating the value of that copper ore mine, the copper ore value can be identified from the London Metal Stock Exchange. That is perfectly fine. But it's a commodity price that we are speaking here. So don't be under confusion that particular price will be used under the market approach for comparable company multiple.
Ma'am, you're on mute.
Alu sir, would you like to add on something?
Sorry, I'll speak less. But one other thing, probably Paragji or Rashmi, if you can explain, is also the option approach, which can also be used in this. This is one industry where probably there is option approach which is also used, except probably in ESOP in regular parlance. Maybe that is something you can throw light on. Sorry, I will request one of you to. Thank you.
Rashmi, do you want me to take up? I can take this up. Yeah, okay.
Yeah.
So rather it's one more industry where we heavily use real option, that is pharmaceutical industry. I'll try to first lay the context why we use the option valuation. Without understanding that context, I believe people, everyone would be confused, why the option valuation comes in this mining. Okay, so the fact of the case is this: you have right to explore in the mining industry. Similarly, try to compare it with the pharmaceutical industry, where you have a patent of a particular molecule, let's say, but there are government regulation in terms of at what price can you sell a commodity that will be ultimately produced. Okay, or irrespective of the government regulation, the market demand is not there. So sometimes we say that you are early mover, but the market is yet to develop for that particular purpose. You can imagine, for example, today, is there a market where, are we regularly traveling to the space? May not be. So market is yet to develop for that particular level where we actually, occasionally go out and travel to the space. Similarly, a particular disease, okay, in the pharmaceutical company, from the pharmaceutical industry perspective, you can imagine that a particular disease is there, but it is not yet pandemic. Okay, so a molecule of a vaccine is ready, which works to develop the antibodies in the human, but somehow the production of that molecule to the level is not commercially viable because that disease has not yet spread, right? But the right to produce that vaccine is only with that particular company. Similarly, from the mining perspective, imagine that there is basically a particular element, maybe a gold or silver or any particular metal, which can be extracted, but presently, let's say the price is not at a level at which the highest and best probable profits can be extracted by the company. That's why artificially company wants to create the scarcity of that product by not doing the mining as of today. They have the mining rights for 40 years. So let's imagine that there is a company in India which has huge oil basins. Okay, now the company says that it knows that the electricity vehicle is not going to work. Just hypothetical assumption. And presently, when the petroleum prices were, let's say, less than 100 rupees, the company said that I'm not interested to extract the oil and then sell it in the market. Only when the oil prices are now crossing 100 rupees, now company says that now I can go out and start producing, extracting the oil, which can further be which can be further converted into the oil, the petroleum, etc. So company has an option not to produce today, but to produce going forward. And that right to explore is granted by a particular license. Okay. So ability to draw profits in future years at a higher price is basically the real option. So certain mines which are proven mines but not under production can be valued on the basis of real option. So that's a context and conclusion of utilization of real option, where you say that I have right to utilize it in future. And obviously it's an option value mechanism that we do it. For better technical understanding, one can actually read the text of the standard. But yes, we use it in pharmaceutical industry, and we use it in startup industry driven by some typical technology, and we also use it in a mining industry where there are proven reserves.
Next is, would geospatial study be considered?
Madam, can you repeat? We could not hear it clearly.
Geospatial study be considered.
Rashmi Madam, you want to take it up? We are using it, but you referred to the initial stages, so maybe you can take this up.
Oh, is that the full question?
Yeah.
Considered where, as in?
This is the full question. Actually, there are many abrupt questions only, like two or more nature of minerals mined, example rare earths with say copper, zinc. Then one is surface mining, example mountains for certain resources.
Okay.
It's really difficult to understand the questions, but yes, these are the questions. And one is ESG impact.
So for all previous and abrupt questions, I would say, yes, all these studies are important. They need to be considered. Under the valuation standard, we have a separate paragraph which says that chartered accountant and valuers must utilize these studies, and they should heavily rely on technical expert, provided that they ensure there is a reasonable assurance in terms of the quality of the content of the report and the conclusions drawn. So there is a specific paragraph in the standard which says that the engagement can be formed with the technical expert, and his inputs definitely can be used. So there is no doubt about it. Rather, it must be used. Without looking at the technical studies, if you believe that there is a reserve, then I think we are under the professional negligence. So that must not be done. Rather, these studies must be referred to. That's a first conclusion. On an ESG part, maybe Rashmi Madam, you want to first say something, then I'll contribute.
I would like to
stop sharing.
Okay, sorry. I would like to mention on this the study bit. So yeah, whether or not you have that knowledge as of now, there is always a provision that you rely on experts, because everything is very technical as far as this particular sector goes. So the level of reserves that are there, or the exploration prospects, the production and development prospects, if we are not very sure as to how the projections are met or how the projections are done, you should definitely rely on some technical expert comments and basis. Then coming on the question where you find two or more minerals, in one place, then definitely their forecasts will be different because of the way they are priced. And it's possible that the extraction procedure and the costs involved is also different. So yeah, you may try and do a SOTP in such cases, and then obtain the final value. For ESG, I think Paragji, I'll leave that. I'll take that for you.
Okay, so just for the benefit of everyone, ESG means the impact. I mean, ESG impact on valuation means the industry what we are looking at, if it is impacting the environment or the social structure or the overall governance, how we look at it. It has been now well proven by the market through the prices, again, not through the cash flows, but definitely by the market, that companies which are well in ESG, those who are able to well maintain their environmental impact, their social footprints or governance footprints, these are the companies which are getting better prices in the market. So you look at some of the companies which are more socially responsible, they obviously get priced higher on the stock exchanges, right? So on an environmental side, one can always look at the mining companies, at the companies who are degrading the environment or etc., right? But look at it from the other side. The optimal utilization of all these minerals, etc., rather in turn help us to build up the better infrastructure. And the better infrastructure means the lower carbon footprints, etc. So obviously, these companies are also expected to do many disclosures from the ESG perspective. If these companies are, and most of these companies are listed companies, so there is also peer pressure and public pressure to be more accountable. In a valuation, we definitely look at the pricing points. The companies which are having any negative reports or negative news on ESG obviously have to face the brunt of the lower multiple or lower pricing. And I think when we do the comparable company multiple, that's where the ESG can be looked at it. Rather, I'll recommend each valuer should consider ESG not only in the mining industry but also in many other industries, because this intangible flavor of ESG is definitely playing a vital role. And that's why we have different multiples of different companies with the same technology. In Indian context, to look at a technology company, one company having a PE multiple of 7 and another company is having the PE multiple of 3. Basically, that fundamental difference is because of the matured ESG approach of that company. And the best example is the Tata Group that we have. Irrespective of these companies in the loss making couple of years back because of they were hit by pandemic, you can look at the chart, okay, the share price of these companies, and then you will notice yourself those companies which are good in ESG get a good price or better price. But please note that ESG may not get directly reflected in the income approach. Indirectly, one can claim that some other companies will decide not to buy from these companies, but these are all false claims. In a market approach, I will believe the ESG analysis is required. In the net income approach, I believe it is difficult to accommodate for the ESG analysis.
If I may come in on this particular point, Sarika ji, there is also another aspect of ESG
Yes,
which is unique again for the this industry, extractive industry, which has significant amount of regulatory and other requirements on maintaining the environment and sustainability, especially with regard to the requirements, mostly regulatory in many countries, with regard to redoing the place after the mining is done, and that the mining is done in a manner that it does not affect the ecology and geology of the location, even though theoretically speaking you can extract much more. So all these are expected to be built into the cash flow models which are being used for the valuation, and this is one of the critical components which may have to be considered in that, both from a perspective of what is that which can be extracted and what cannot be extracted when you have to meet these ESG requirements, and two, in terms of the costs which the company will have to provide for in meeting these requirements. So that is another aspect also which could be important in extractive industry specifically.
Thank you, sir, for this detailed explanation. Another question is, I think the standard should specify the market cost or income approach for each property, such as exploration, resource, development, and production.
I think we had it in the PPT, and we can either have it through guidance note subsequently, or we could also have as a standard. I think we can take a consent from all on this.
Yeah. Next is with respect to country risk evaluation. If a company is extracting locally, but all the extracted content is exported, which country risk do we look at? The country of extraction or the primary country of exports?
So I will look at it. So first, the country risk, I look at the country in which the extraction happens, because that's where the government regulation is there, and that basically whether you can export or not is dependent upon the policy of that particular government. So for example, can we export, let's say, some critical mines here and export to Iraq and Iran? Answer is no, because there are sanctions, right? So it is now the country risk of the country to which we are exporting. So let's not be rigid in adopting or analyzing the country risk. If you are exporting to the country where the potential sanctions can happen, let that country gets captured in the cash flows and not in the discount rate. For other exports where the sanctions are sanctions on the exporting of the country into which it gets exported are not looked at, but the country in which the exploration happens, then obviously I will try to capture that country risk in the discount rate. So that's how I'll do that.
All the questions I've already taken up, and we have now with us 1400 people live with us. Do we want to explain any other thing, or we can wind up for the day, because we have already explained the standard or draft standard in detail and also taken up the questions that were available with us. Balu sir, Parag sir, Rashmi ma'am, can we wind up the session for today?
Yes, I think unless we have anything else to discuss, we can wind up for the day.
Sure, ma'am.
Yeah, I also feel so.
Yeah. So thank you, sir. Thank you, Balu sir. TV Bala Subramanian sir. Thank you, Rashmi Shah ma'am. Thank you, Parag sir, for taking up this exposure draft in detail. Thank you all the participants. We have this exposure draft is live with us for comments up to 27th of this month. Like MPV sir, I would again request you to share your thoughts, share your issues, so that we can incorporate this in the standard, and we can have a comprehensive broad guidelines in the standard for specific assets. So thank you all the participants, Anil Bhandari sir, MPV sir, Rakesh Sehgal sir, and all the speakers and the delegates. Thank you so much. Goodbye.
Thank you.
Yeah, thank you so much.